Options trading can seem complicated, but it can be a way to make extra money. Options are contracts. They give you the right to buy or sell a stock. This happens at a specific price, and it happens within a certain time frame. Many investors like options. They can use options to profit from market moves. A covered call is an option strategy that can help you generate additional income from the stocks you already own. It's a popular strategy among investors looking to enhance their returns without taking on too much additional risk. In essence, you sell call options on a stock you already own. This means you're giving someone else the right but not the obligation to buy your stock at a predetermined price within a specific time frame. Let's say you own 100 shares of MicroStrategy, MSTR. This is a significant investment and you want to make the most out of it. You could sell a call option with a strike price of $500. This strike price is the price at which the buyer can purchase your shares. This means the buyer has the right to buy your shares at $500 each, regardless of the market price at the time. This transaction must occur before the option expires, which is typically within a few months. In return for selling the call option, you get paid a premium. This premium is essentially the price the buyer pays for the right to buy your stock at the strike price. If MSTR stays below $500, you keep the premium without having to sell your shares. This is an ideal scenario for many investors. Plus, you keep your shares, allowing you to continue benefiting from any future appreciation in the stock's value. But if MSTR goes above $500, your shares might be called. This means the buyer will exercise their right to purchase your shares at the strike price. This means the buyer will buy your shares at $500 each, even if the market price is higher. You still get to keep the premium, which can help offset any potential loss from selling your shares below the market price. This strategy can be a win-win if executed correctly. Another strategy that traders often use is a cash-secured put. This strategy can be a great way to generate income or to potentially buy stocks at a lower price. In this strategy, you sell a put option. By selling a put option, you are essentially agreeing to buy a stock at a specific price if the option is exercised by the buyer. However, it's crucial to have enough cash in your account to cover the purchase of the shares if the option is exercised. This is why it's called a cash-secured put. For example, let's say you sell a put option on MSTR with a strike price of $379. This means you are willing to buy MSTR at $379 if the option is exercised. If MSTR stays above $379, the option will likely expire worthless, and you get to keep the premium you received for selling the put option. But if MSTR falls below $379, you might be required to buy 100 shares at $379 each. This is the risk you take with this strategy. This process is known as being assigned. When you are assigned, you must follow through with the agreement to purchase the shares at the strike price. Despite this, you still keep the premium you received from selling the put option. This premium can be seen as a form of income. The premium helps to lower your overall cost basis for the shares you might end up buying, making this strategy potentially profitable even if the stock price drops. Options trading can be risky. You could lose money. It's important to understand that the potential for loss is significant, and you should be prepared for the possibility of losing your entire investment. You need to understand the risks before you trade options. This means doing thorough research and possibly consulting with a financial advisor who can help you navigate the complexities of options trading. Covered calls limit your potential profit. While they can provide some income, they also cap the upside potential of your investment, which means you might miss out on significant gains if the stock price rises sharply. Cash-secured puts could require you to buy a stock at a loss. Always do your research. This strategy involves setting aside cash to buy the stock if it falls to a certain price, which can tie up your capital and expose you to further losses. Don't invest money you can't afford to lose. This is a fundamental rule of investing, especially in high-risk areas like options trading. Make sure your financial situation can handle potential losses. Options trading isn't for everyone. It requires a certain level of knowledge, experience, and risk tolerance. If you're not comfortable with the risks, it might be better to explore other investment options. Talk to a financial advisor to see if it's right for you. A professional can provide personalized advice based on your financial goals and risk tolerance, helping you make informed decisions. This information is for education only. It's not financial advice. Always do your own research and consult with a professional before making any investment decisions.